Is a 30-year endowment plan worth it? In this episode of Rate My Plan with Biscuit, we're looking at the policy sent to us by Miss Rina. But first, what is an endowment plan? In a nutshell, it is a type of insurance plan that offers life insurance cover as well as long-term savings with assured returns. You pay a premium every month, and after say 30 years, you'll get a guaranteed cash sum and a little more. Because of this, an endowment plan is sometimes called a savings plan or a wealth accumulation policy. For Miss Rina's plan, she'll be paying 2,400 ringgit per year for 20 years. A portion of this amount will be allocated into an investment fund, and at the end of 30 years, she will receive a maturity benefit. She will also receive a guaranteed cash payment every year until the payment matures. Let's rate it. First, life protection. This plan pays a lump sum for death and TPD. The amount is calculated based on a formula, which at best pays out about 50,000 ringgit, so the amount is not very large. Now, Miss Rina is single and she doesn't have anybody who is financially dependent on her. So for life protection, it's really not relevant. Next, simplicity. This is not a straightforward endowment plan. There is a guaranteed cashback feature that returns to Miss Rina anywhere between 20 to 60% of the premium she has paid. Now, while this sounds attractive, the cashback clouds the actual cost of the policy. This feature requires me, even as a CFP, to create a special Excel spreadsheet with 30 rows to see how the cashback affects her returns. Sadly, I think the guaranteed cashback feature is just a marketing gimmick, and gimmicks deserve zero biscuit. Finally, value. Remember, Miss Rina will be paying an annual premium of 2,400 ringgit for 20 years. This works out to a total amount of 48,000 ringgit over the 20 years. For this, after 30 years, she will receive maturity benefit of up to 50,000 ringgit, depending on how good the investment's returns are, and a cashback of 28,800 ringgit paid over the 30 years. The gimmick. In total, Miss Rina pays 48,000 over 20 years and gets back up to 79,000 over 30 years. Now that sounds pretty good, right? Well, not quite. When we calculate the annual return of the plan, even after including the guaranteed cashback and the best case for projected returns, it's only about 3.3% per year. Compare it with EPF, which gave an average return of almost 6% over the last 10 years. If Miss Rina had instead made the same payments into her EPF account, she could end up with up to 167,000 ringgit after 30 years. That's more than double the return even on the insurance company's best case scenario. Other pure investment products, like a robo-investment service, could net her an even higher return. So, for value, just one biscuit. Here is a suggestion for Miss Rina. She is only in year 4 of her endowment policy. If she were to surrender her policy today and instead divert her premiums into her EPF for the remaining 16 years, at the average return of about 6%, she would end up with 129,000 ringgit. Compare this to her endowment plan benefit of 79,000 today. So Miss Rina, I would recommend you surrender your policy even if you have already paid 4 years worth of premiums. I know, sounds bad, but it's good. We also recommend you to get a pure protection plan that covers total and permanent disability. You can sign up for a 1 million ringgit plan for as little as 60 ringgit per month. Moral of the story, please stay clear of gimmicky endowment plans like this one. That's it for this episode. Keep those plan details coming to hello@fi.life. Until next time, thanks for watching.